All right, Eel Nerds, episode 142, and I will be discussing what to me is a very unique bond market opportunity right now. It is because there are early rumblings of a bear steepening. Look at that bear climbing up a steep incline. That is what bear steepening is all about, and I will explain that in greater detail. We are at 388 subscribers. Thank you for your support. And if you're new, please remember, I didn't know bear steepening from a bear climbing a steep wall a couple of years ago. The content of this is my own education on fixed income, and I've shared it from a beginner level and up to now. And so if you're new, feel free to use the playlist, and it starts from a middle schooler grade, and that is where I was a couple of years ago when it came to fixed income. Mainly, yeah, no matter how experienced you are, please remember that what I am sharing is my education. I do not have any magical powers of prediction, and I'm wrong. So make sure that you check and do your own analysis. Well, I have four parts to the agenda today. First is to take a temperature check of the market and then dig into this bear steepening, which is a fancy buzzword, and we'll understand what that is and is the market really showing the behavior of a bear steepening. And then I'll play my favorite game, which is Yield Superbowl, and inform you of my trades and next steps, and you do you. My portfolio, which is the blue line, I like to call it the no drama portfolio. It doesn't have the crazy ups and downs. It just kind of chugs along, bringing me about 1.5% every 3 months. I'm happy to get that return. And there is the Russell. The Russell had an absolute choke in the last few days. And you can see even my no drama portfolio had a little bit of a downward trajectory, but the Russell crashed and burned. And as for the Nasdaq roared ahead and again crashed a few days ago, and I chug along, and that is generally my strategy. I'm not looking for the huge ups and downs. I'm looking for nice returns, fixed income, and I will get into equities as the opportunity presents. Speaking of as the opportunity presents, you could argue I have increased my allocation for equities by 600%, and that is true. I went from 0.4 something percent to 2.6%. Look at that. And even that is tiny compared to where most of the people are. They do a 60, 40, 70, 30, something like that. And I'm not that enthusiastic about jumping into equities like that. So I'm going to do my own measured approach. Most of my assets, as you may know, if you've watched prior episodes, are in short-term treasuries. And I do have some investment grade corporate bonds, and I'm doing a couple of things based on the bear steepening that I observed, and I'll let you be the judge of what you should do. My durations are mostly short term, although I am accumulating some long term. And so, with all of that kind of a prelude, let's talk about what bear steepening really is. And it's a buzzword that is used in the bond market, specifically when you look at the yield curve. And so here is the general concept, and I've posted links to all of the references in the description of this video, so feel free to consult with that. So if this is your yield curve, and as soon as you see that shape, you already know we don't live in that reality. This is a non-inverted yield curve where you get lower yield for holding shorter term durations than longer term. But assuming that we're the yield curve, a bull flattening means the yield curve is less inclined, so the longer end flattens a lot when the shorter end goes down a little. So Chairman Powell drops rates by 0.25% and the longer end comes thumping down. That would be bull flattening. Bull steepening says even though the government is begging people by saying, hey, we've dropped interest rates, come on, let's do this, we're going to stimulate the economy, the longer end is like, I'm not quite sure. And that is the bull steepening. And the bear flattening goes in the other direction, where the government increases interest rates, but the long term doesn't rise up as much, and hence the flattening. And the bear steepening is where the government increases, or the Fed increases the interest rates by a smidgen, and the long term goes up by a big amount. And that is the steepening, if you will. And so let's take a look at our own treasury curve and see if any of this is happening. And the thing that I want to reiterate before I move further, in all of these pictures, the one thing you should note is that the arrows move in the same direction. Both moved up or both moved down. Remember that? And we're going to go look at our own yield curve. 12 months ago, we have the inverted yield curve. We still do. 12 months ago, we had a curve that looked like that. People today would salivate at making 10%, 5% sales tax-free yields for a 10-year treasury, but that is what we had just a year ago, October 23. 5 months ago, we saw bull flattening, meaning the front end came down by a quarter point or a half point, pardon me, and the back end came crashing down, and that's the bull flattening, except on an inverted yield curve, it doesn't really look like it's flattening still, but that is what happened. Well, something really strange happened a month ago, and I pointed it out at that time as well, where the tails started going up. And the front end went down by half points because the Fed did follow through after their first meeting. They announced they were going to do something and then they followed through. And so the front end of the short-term interest rates dropped by half a percentage point. And ironically, the long end, instead of completely dropping, which is what you would remember, if you remember the previous slide, they should move in the same direction. The rear end kind of came up a little and you go, what's that? And looking at it today, it looks very much like a bear steepening, except in a different order. In bear steepening, the longer end rises faster than the shorter end. Here, the longer end is rising faster, except we do not yet have any change in the short end. And you would say, how is that? There is an argument being made with respect to longer term treasuries. That is what the market is trying to tell you. Now, you may remember when yield goes up, it means demand is decreasing or supply is increasing or both. And that is what is pushing prices lower. So if you could buy a treasury for 93 cents that matures at $100, that is a much better yield than buying a treasury for 99 cents that matures at $100 for the same duration. So what this is saying is the treasury, instead of selling at that 99 in our hypothetical scenario, is selling for 98 or 97 or 96. So the price is falling down, the yield is coming up, and that should wake you up to, what's going on? So how do you understand a curve like that? So in theory, the bond market is saying, well, we think the longer terms have been high enough that we think the longer term rates, 10 years, 20 years, 30 years, will stay exactly at that 4.5% while the Fed brings down the short term rates. Or here's the other crazy possibility. The crazy possibility is the Fed thinks Chairman Powell cut the rates by 50 basis points, 0.5%. And when Chairman Powell did that, he expected that the economy would be sputtering, he had to rescue it, but in reality, the economy is doing fine. And because the economy is doing fine, he cannot cut short-term interest rates more. And if he cannot cut short-term interest rates more, then we will create a recession. The recession will weaken the US dollar. It will, because we have a crushing debt load, and everybody will run away from long-term treasuries. And since everybody is going to run away from long-term treasuries, the bond experts, we are going to run away before others catch on, and hence the yield is going up. Well, at least that is what one possible interpretation of a bear steepening before the short end reacts could be. Well, do we have a debt problem? You bet. Our debt to GDP has gone up, and away, and especially when GDP was at a standstill during COVID, the ratio obviously spiked because debt went up by a little bit, GDP went down by a lot, and that makes the ratio even worse. And since then, we've tried to crawl back to a lower number, although we've not been able to come to the pre-COVID numbers because we have so much debt and GDP is not growing fast enough. And so is there a debt problem? Absolutely. However, Here are the contrasting countries that are in the world today. I'm going to hide the name of this country. There is a very dramatic article. Why country X? And we're going to call this country Jambalaya. Why country Jambalaya has turned into a nation of debt slaves. And it is a real country. I'm going to tell you who it is in a second. And it is a developed nation, which is a scarier thought. And they are saying that the number of suburbs where the median home price is more than $1 million in local currency, that has doubled in just 4 years. Imagine this, walking into a new suburb and the average home is $1 million or more. And that makes people who own the home to either service their mortgage or buy a new home or go anywhere else. It just them to that home. It's a very strong language there to use. And the article goes on to give additional insights. It says, here is what happened. In this particular country, the average suburb has home prices above 1 million, and new couples cannot buy homes. They don't have $1 million because homes sell for 1 million. New couples only make 100,000. And so imagine going to a bank and saying, I'd like a loan of $800,000. That makes no sense. So the banks are sitting there saying, I'm not sure if I can lend you. And once people say, I can't get the loan, they then go into rentals. Homeowners cannot get out of their existing homes. They are house rich, cash poor. And now the country is talking about rate cuts. They say deficit is high, or interest rates are high, and they are at 4.35%, and they're saying we're going to cut rates. And they are saying, oh my God, if they cut rates, home prices are going to go up even more. And what a scary thought that the average home would be even more than $1 million. And nobody is getting raises anytime soon, at least nothing to match that kind of purchasing power. And so they think there will be a bidding war on homes when interest rates come down, where people can afford more, and so they're going to bid up the prices of homes. It's nutty, but the household debt level in that country is 185%, almost double of what the United States is. And not only that, they say, hey, we would be an egalitarian society if only our home market crashed and we did not have so much debt. A very scary reality. And that nation, I called it Jambalaya, is none other than Australia. As scary as that sounds, Australia is living in a housing crisis that they think is going to implode in the next quarter or couple of quarters. And I give that as an example to contrast with US debt to GDP ratio. Oh my God, everybody is going to run away from the dollar. And here is another country, a developed nation, and the link is also there in the description. How about our favorite friend, Canada? Canada is not that far off from Australia. Again, another very, very scary. And so Canadians on average have a household debt that is far more than their disposable income. And the same thing could happen there. By no means am I suggesting the US does not have a housing crisis. I just want to point out that if you now say that the bear steepening is an indication that American debt, long-term debt, is a terrible thing to hold, well, you're not going anywhere near Australia. You're not going anywhere near Canada. Well, what about other countries? You say, I've been hearing about China a lot. Maybe American treasuries and go to China. Let's take a quick look. The US does have a public debt problem, or public debt as a percentage of GDP is high. But check out China. China has a huge private debt problem. The average Chinese family, the average Chinese business, one way or the other, they are stuffed into owning debt. And the debt-fueled economy can only go so far. You can keep decreasing interest rates. You can give them free stimulus money. China, all kinds of things to try and get them to reinvigorate. However, if your debt is 200% of your GDP, how many people have that free cash flow to spend? That is what China is experiencing right now. Once again, the point I'm trying to make here is You can squawk all you want about the US dollar is losing its purchasing power. There is no other place to go to. If you look across the world in all the advanced economies, I don't really care about the forecast, I just look at reality. The US is worse off, but it's not like there is a better alternative. China is on an exponential upward trajectory. The emerging markets do have lower debt, except they just don't have a good enough where you can say dump the US Treasury and go buy some other country's treasury. That just isn't there. Now, do we have a debt problem? You bet. Do we need our politicians to come together and address it? Absolutely. These are severe problems. We cannot have a credit crisis. Fortunately for the US, there are few other countries that actually are at the brink of a greater collapse. Now, if Australia collapses, Japan collapses, these are economies. And so, if Australia, Japan, Canada, if they have a credit crisis, that will create financial issues in the US, make no mistake. But my humble opinion is that the US dollar will still be the one-eyed king in the land of the blind. There is a separate episode on that area alone where we go into every economic indicator. I encourage you to watch that and make your own decisions. But the moral of the story here is those who are showing the precursor to bear steepening, saying, oh my God, the country is going to boil over and all things are going to go haywire. My instinct tells me, there may be a little bit of truth. Yes, there is a problem, but the idea that the American dollar will lose its value and be substituted by something else. I'm not a Bitcoin guy. You can do whatever you want with it. Gold is a non-producing asset. So you kind of come down to a box of you don't have any other better choice. So where else can I park money on the fixed income side? Did I forget to mention so far, and my disclaimer applies to the whole episode, I am not a wealth management advisor. I don't do politics or product. This is not investment or tax advice. Make sure that you do your own research. Here is the yield Superbowl. I've shortcutted straight to the results, and I want to make sure that you watch previous episodes to understand what it is. But on a tax adjusted pre basis, in the very, very short, treasuries still hold the edge. Ironically, for 1 year, bank CDs seem to match the pre-tax treasury yield. After that, very interesting things happen. There are very high yield agency bonds. However, they are immediately callable. And I'll explain what that means in a second. They are even more callable now than they were before. However, what really strikes out to me here, what really appeals to me here, is corporate bonds appearing as a new champion on the long end, and they are giving north of 5.25% yield for 10 years on a tax adjusted basis. And they beat treasuries. And so, very interesting. But before I go to corporate bonds, I want to highlight what the agency bonds, the immediately callable agency bonds are. Here is a 10-year agency bond that pays 6%. Sounds lovely to me until you realize it is callable 3 months later. Used to be the callable 6 months later. I actually found a couple of bonds that are callable 1 month after the settlement date, which is obnoxious. So you think you're locking in yield for a longer time, and it gets called very, very quickly. So if you make a 3 month CD, if you will, put it in a bank where you're almost certain to have that be called, I suppose you can buy the long end of agency bonds. That is one thing you could do, but I always only buy things I'm prepared to hold to maturity. Make sure you think about that rule. So given all of that, what are my trades and my next steps? Well, I did everything that I noticed in this episode. I bought those corporate bonds, Merck and BNSF, and the QSIPs are right here. Merck and BNSF, those two bonds pay 4.9% coupon, but they are trading well below par. And so they have a yield of 5.3%. Thank you. I bought a bunch of them. I still am going to rotate a good amount of my portfolio into the really short-term treasuries right after the election. And I did get an FHLB, that is the quote immediately callable FHLB, so I can just ride along and get 6% for 3 months or 6 months. On the equity side, it's a whole bunch of same old, same old. I Pulte home and Pulte had a huge drop in their price by about 5%, and I like it. And I did sell ELTP, but outside of that, everything else is stuff I already own. Here is my portfolio. It is no surprise from before in the sense that I have Costco and Cal-Maine Foods for food. I still have most of the storm recovery stocks. You need new roads, you need to repair electric connections, landfills, school buses, trucking. So I have stuff like that. And I by now have four water-related stocks because I'm not feeling too good about world peace, let me put it that way. And then I have the two home stocks. That is me. You do you. Please share your feedback and thank you for watching Yield Nerd.